Hi, everyone. Welcome to another edition of We Are Talking Money. I'm Phil Clark, wealth advisor and founder of OmniStar Financial Group.
And I'm Dustin Hawken, wealth advisor here at the firm.
When it comes to planning for your finances for retirement, everyone gets so fixated on the money and how to grow it. But there's something else, Dustin, that people should get fixated on, and that's taxes.
That's right, Phil. Taxes can play an important role when it comes to accumulation and distribution in your financial plan, and it's not talked about enough. Today, we're going to talk about the top tax mistakes that we see every day with clients. Before we get started, Phil and I invite you to hit that thumbs up button and subscribe to our YouTube channel if you love this type of content. We're putting out new content weekly, so be sure to ring the bell so you're notified of all of our new videos. And let's get started. Mistake number one, failure to diversify your retirement accounts. Phil, we see this a lot. People pump money into their 401k over and over and over throughout their entire career. They get to retirement and all their money's in an IRA. We think that diversification is key when it comes to taxes. Roth IRAs, taxable investment accounts, very important.
Yeah, we're not talking about diversifying investments here. We're talking about the vehicle in which those investments rest. Everything should not be in one account, and it has to do with taxes. Tell us about it.
That's right. So an easy way to look at this is, and how I explain this to clients, is if we need $10,000 a month of retirement income, where are we going to get that income and how much tax are we going to pay? So let's just assume, I don't know, we have $3,000 to $4,000 a month of Social Security. So now let's say we need another $6,000 a month of income on top of our Social Security. Well, where are we going to get it? So if we only have 401k money or IRA money, well, we have to pay taxes on that. So if we need $6,000, we probably have to pull out $8,000 to get the $6,000. So now all of a sudden we're paying $2,000 a month in taxes, $24,000 of tax throughout the year. The other option is, what if we have some money in a taxable brokerage account or potentially a Roth IRA, and we can say, why don't we take $3,000 taxable and $3,000 tax-free? So on that $3,000 taxable, we may pay $1,000 a month of taxes. Well, we just cut our taxes from $24,000 a year to $12,000 a year.
Huge change. That alone takes the requirement of such a large distribution out of the equation, so now that money can last a lot longer, right?
Exactly.
Okay, so next we're going to talk about legitimate tax deductions, and while they're legitimate, they get missed a lot.
Charitable deductions, medical expenses. There could be mileage on your car if you own a business. We see this a lot with business owners. There's square footage in your house if you work in your house, cell phone if you're using some of those calls for your business. So there's so many different legit tax deductions that you just want to be aware of. So many people want to give to charities, but sometimes people will give cash to charities. And really, that's one of the most ineffective way to give money. So a couple options just to throw on the radar. One is a qualified charitable donation, or QCD. So this is if you are over the age of 70 and a half and you have a required distribution, you can actually give that RMD to the charity so that distribution never hits your tax return.
Better than a tax deduction. It just doesn't show up on the return. That's $100,000 that escapes the tax return. And that affects other things like Social Security. Other things could be taxed because of that distribution. In this way, it's removed. Big tax saver.
Yep. Another great charitable strategy is to give highly appreciated stock. So most charities, especially if they're large enough, they're going to have some type of brokerage account that you can donate stock to, and then they'll liquidate. They won't have to pay any taxes on the capital gains, and you'll get the full value of the gift.
Speaking of those required minimum distributions, Dustin, so those become very important. It's crucial that you understand how they work, because failure to take them can lead to some big penalties. And the problem with the required minimum distribution is they're not going to affect everyone the same way. Depending on whether you're a spouse or a non-spouse, a trust, a charitable entity, those things get affected differently. But if you are supposed to take an RMD, a required distribution, and you miss it, 25% tax penalty stripped away from you, and you're not going to get it back. And it used to be 50%, so we've actually gotten a benefit from Secure Act 2.0, but 25%, that's a hard tax.
Wow, 25% is a big cut. What if you inherit a Roth IRA?
And so a Roth IRA, they have required distributions as well. Yes, they're tax-free, but when it comes to required distribution, you still have them. Now, if that account has been in place for 5 years, likely all the distribution is going to be tax-free. But if you inherit a Roth and you're not the spouse, you still have to make those required minimum distributions.
Not contributing to retirement accounts and other tax-deductible accounts. This is very common because people, maybe they have the money to save, but they don't know where to save it. And they might just put it in a joint account or an individual brokerage account. Take advantage of the retirement accounts and those tax deductions. So 401k, for example, you can put in $22,500, and that's 100% deductible each dollar you put in. If you're over 50, you put another $7,500 for 2023. That's $30,000 tax deduction right there. Also, Roth IRAs, take advantage of those. So those, you don't get a tax deduction today, but they grow tax-free, and we can pull them out tax-free in the future. The other account that's missed a lot is the HSA or health savings account. We have other shows, so please watch our videos on the HSA and everything you need to know. But the HSA is great because it's all tax deductible going in, grows tax-free, and if used for qualified medical expenses, 100% tax-free. Great deal.
Huge opportunity. Don't miss that HSA. FSA, be aware, that is a use it or lose it. So if you're putting money in the FSA and you don't use it in the year that you made the contribution, you're going to lose that. HSA, on the other hand, you take it all the way to the end. This one gets missed a lot, not using losses to offset your gains. On the surface, it's pretty simple. So capital gain and capital losses can be used to offset one another. For example, if you had, say, a $6,000 gain and you could sell maybe a losing stock in your portfolio that has, say, a $4,000 loss, you've all of a sudden netted the taxable component in that equation to only $2,000 that would have a capital gain tax. If you had more losses, maybe you went through 2022, which was a pretty bad year in the stock market, maybe you had more losses, you could offset all of that capital gain. So keep that in mind. And what you don't use, we can then take away up to $3,000 on your ordinary income. And if that doesn't use all of your losses, we can actually take it to the following year. So the carry forwards are powerful. Don't forget those losses, and there's great ways to use that, but most people don't know how.
We talked about this one earlier, not hiring a tax professional. Now, this one is a conversation that we have quite often because sometimes people's situations aren't all that complicated, and they think, gosh, do I really want to pay $500 or $600 or $1,000 for someone to just file my taxes for me when I'm taking the standard deduction? There's not much going on there. And what I always say is it's worth the money for the peace of mind and knowing that you're not missing out on anything. And I have a story here. When I was in college, didn't have much money. One year I tried filing my own taxes. And when I filed my taxes, this is a true story, I had to pay $600 back. First time in my life I had to pay any taxes. Well, I was worried because I didn't have $600 at the time. So I talked to my parents and they say, well, file taxes with the person who we always file the taxes with. I said, okay, sounds good. And so she files the taxes for me, and I actually get $1,000 back. Total game changer when I was a broke college kid. So I tell that story a lot, but make sure you hire a professional. It's worth the money. Also, when you're looking for a professional, make sure they're what's called an enrolled agent. So this is someone that is legally obligated to work on your behalf if you get audited by the IRS. Really important there. You don't want a CPA or an accountant that really can't be with you if you do get audited.
Tax credits are much more powerful than a tax deduction, but people miss them a lot. Here's what I mean by that. If you get a deduction of $1,000, that deduction's great. And if you're in a 25% tax bracket, it can save you $250. If it's a $1,000 tax credit that you're missing, that could have offset your taxes dollar for dollar, $1,000. So you don't want to ignore tax deductions, but you certainly don't want to ignore tax credits. And there's lots of them out there. If you have questions on those, call us. We're happy to help you with them. Depending on your situation, you might have tax credits that you're missing. That's another reason, Dustin, why hiring the pro is a wise move. And yes, they're going to cost some money, but just like your story, where whatever you did to make you owe $600, I don't know what that was.
Probably did not getting the tax credits.
You probably missed a tax credit, but then all of a sudden you get $1,000 back. That was well worth hiring the pro.
And lastly, not staying informed about tax laws changes. So you mentioned it, Secure Act 2.0. A lot changed just a year ago. So making sure you have a professional, again, who's up to date with the tax changes, because what worked last year really might not work this year, and you want to be sure you're aware of everything.
And to your point, Dustin, our tax code, I've said this in other shows, it's voluminous. The people that write it they don't even know.
Right.
I mean, no one's read the tax code from cover to cover and can honestly say, oh, sure, we understand it. They'd be lying if they said that. It is incredibly complicated. It even says things in one place that contradict the same kind of thing in another place. So there's lots of ambiguity in our tax code. You will never know all of it. I don't believe there's a CPA that knows all of it or any tax expert, but I think the more expertise you get on your team, the better chance you have of taking advantage of all that the tax code has to offer.
Yep. Take out my yep. That was stupid. Yep.
Yeah. Yes, sir. That's correct. So there you have it. I hope this video has inspired you to get a little more in touch with your tax planning, whether that means you're doing it or you're hiring the tax professional.
When it comes to financial planning, each element is important because actions in one element will affect another. So tax planning is critical, whether you're getting ready for retirement or you're already in retirement. Making smart decisions today will make a difference.
We'll see you next time on We're Talking Money.
Thanks for joining us on We're Talking Money. Be sure to visit us at omnistarfinancial.com, where you can learn more about how we provide value to our clients. Subscribe to the show and our newsletters, and drop us a line with topic suggestions for upcoming shows. If you enjoyed the show, we would appreciate you passing it on to a friend and providing a rating on iTunes. This podcast is a publication of OmniStar Financial Group. The content is developed from sources believed to be reliable and accurate with all information. The information in this material is not intended as tax or legal advice and may not be used for the purpose of avoiding any federal tax penalties. Please consult legal or tax professionals for specific information regarding your individual situation. The opinions expressed and material provided are for general information and should not be considered a solicitation for the purchase or sale of any security or service provided by OmniStar. All expressions of opinion reflect that of the authors and are subject to change. Any distribution, use, or copying of this podcast, other than the intended recipients, is prohibited.